All right, everyone. I'm just going to say welcome to today's webinar from Headway Capital. Today's topic we're going to be talking about using passive real estate to build a second stream of income. I'm really excited to talk about this topic because the idea or the topic of passive income is something that is one of the first things that people are usually attracted to when they're thinking about investing in real estate, right? Most people invest in real estate because they're looking to create one, generational wealth. They want to build their net worth. They want to grow their balance sheet. They want to protect the wealth maybe that they've built either in the equities market in Wall Street or other types of investments or businesses that they own. But really, the primary thing that attracts a lot of people to real estate, commercial real estate in particular, is cash flow, is passive income. So we're going to talk today about how to build that second stream of income. If you want these slides and you see what you like, just give us a text here, 281-559-7061. Just go ahead and say, please send me the slides for tonight, and we'll make sure we get those over to you after the webinar. Just a quick disclaimer, this webinar is for education purposes only and should not be considered legal or accounting or investing advice. We're just here to educate you, give you our opinion, of course, on some ways you can build a second stream of income using commercial real estate. But you should always consult your CPA, your tax advisor, and of course your attorneys before you make any type of investment decisions. A little bit about us. If it's your first time here, I want to say welcome. I do see some familiar names here in the participants box, but also see some new names as well. So I want to say welcome. Thanks for joining us today. My name is Brian Alfaro. I'm the Director of Investor Relations here at Headway Capital. Headway Capital is a private equity firm based in Houston, Texas, and we were designed and really started to help build and protect the wealth of busy professionals. Our mission and our goal is to provide investment opportunities that give you, the investor, the freedom to do what matters most by helping you build your net worth, helping you grow your equity and your capital, and of course, helping you achieve cash flow. Our team has extensive experience sourcing, vetting, and investing in alternative investments through multiple market cycles. So our bread and butter is multifamily real estate. The company was founded by Sid Shamim and Anam Omer, who you see here on your screen. They started Headway Capital in 2017 after spending about 6 years investing in single family real estate. We have some upcoming topics kind of talking about the differences between the two, so make sure you keep an eye out for those. But they spent some time building their portfolio. They got to 33 or 34 houses, I believe, and then finally decided it was time to make a change. It was time to start building a little bit more of a passive income because managing the portfolio of that size definitely isn't passive. And they started investing passively as LPs, as limited partners, into syndications, into multifamily real estate. And then eventually, about a year later, decided they wanted to be full-time operators. So Sid quit his job, started Headway Capital in our property management company. And I guess you can say the rest is history. Nam is a medical professional by trade, still does that full-time. And spends most of her time helping with business advising, helping us connect to other investors, especially in the medical field, just because she is a full-time physician, but still very involved on our growth here at Headway. And then Mr. Umar Naqvi, he's our CFO and CIO, helps us make investment decisions, and of course helps keep our portfolio in check and operating well as after we close on deals. And then my job here at Headway as a director of investor relations is to talk to all of our current investors, our prospective investors, all of our partners, and to make sure that we're providing the best service we can. And of course, to help educate investors on the power of investing in commercial real estate and to build trust and rapport with all of our investors. Now, our team helps create the Headway difference. You'll see a little bit here about our track record. We've sold several assets since we've been in inception in 2017, but we still own about $440 million of assets under management. Most of that is comprised of multifamily real estate, about 99% of it, a little over 2,800 units, and we target a 25 to 30% average annual return, which means our goal is to try to double our investors' money, your money, in 5 years or less. And we currently have over 500 investors that have invested with us in the past. And you'll see some of their testimonials here on your screen. If you'd like to connect with us or any of our previous investors, please feel free to reach out. Always happy to send referrals. So let's get into the meat and potatoes. Let's talk about why we're here tonight, why we're here today, using passive real estate to build a second stream of income. So let's dive right in. So first of all, you're here, but let's take it down to level 100 in case you don't know what passive real estate investing is. There's some people here, again, I've seen some new people here. They might not know what this is. So let's break it down. What is passive real estate? Passive investing or passive real estate is investing in real estate without the active day-to-day involvement. Active real estate investing is the exact opposite. So if you were to tell me you were an active investor, that probably means you're either doing what I do and you're partnering with investors and managing properties, or you're buying your own single family rentals, or you're managing a strip center. You're active, right? You're very hands-on. Passive investing is the opposite. You don't have the day-to-day responsibilities that we have here at Headway. And it typically involves working with an operating partner, such as us here at Headway Capital, right? So if you're a passive investor, you find groups like us and you partner with us. So how exactly does that work? You partner with us by contributing your capital to help us purchase properties, right? So we form these partnerships, and you come in as a partner, a passive partner, a limited partner, as we call it, and you help us acquire these properties. Of course, we have some skin in the game. We're investing our hard-earned capital as well, but you're a partner alongside us in these transactions. And a sponsor or operator, which is us in this situation, manages the properties while the investors receive a share of the profits, right? So it's kind of the best of both worlds. You get the benefits of real estate, but you don't have to deal with the day-to-day management of the real estate, right? And what type of passive real estate investments are there? Well, our bread and butter is multifamily real estate. Those are apartments. We love apartment. We think they're a great wealth building tool, both for cash flow and for equity appreciation. And then there's hard money lending, right? That's another form of passive investment, although it can be a little bit more active if you're constantly looking for places to loan money, whether it's a fix and flip investor or a rental property. Hard money lending can be a great way to generate some extra passive income. We actually have a hard money lending offering here at Headway that allows you to enjoy the benefits of hard money lending without doing any of the work. We can talk about that at the end. And then there are other opportunities like self-storage, for example. And we don't do self-storage here at Headway, but self-storage could be another great asset class where you can find passive real estate investing. There's also triple net, there's retail, there's mobile home parks, there's office. There's so many different asset classes when it comes to commercial real estate that you can generate passive income from. So what are some of those benefits of earning passive income through real estate? So if you're generating passive income and you're investing in these deals, well, obviously you're looking for cash flow, right? Most operators, including us here at Headway, we pay quarterly distributions based on the rental profit or the rental income, right? So when there's profit hitting the bottom line, we share that with our investors. Some operators do pay monthly, just depends on the deal. There's also tax benefits that come along with passive investing, right? So you get depreciation and other tax strategies to reduce taxable passive income. So when you're investing in these projects with us in particular, especially if it's an equity project like a multifamily deal, you're going to get a tax document at the end of the year called a K-1, and you're going to share that with your CPA, and it's going to show paper losses for your investment. And that you can actually use those paper losses to offset the passive income that you generate from real estate. Now, unless you're a real estate professional and you do real estate full-time per the IRS designation, you're not able to use the depreciation to offset your W-2 income. So this is something to keep in mind. And of course, as I recommend, I'm not a CPA, I'm not a tax advisor. Definitely recommend you consult with your particular advisor or CPA to make sure that they advise you on the best strategy for you. But regardless, there's still great strategies to help you mitigate or kick the can down the road on some of those taxes you would earn from passive income. And of course, if you're investing in projects, there's always the opportunity for 1031 exchanges to defer taxes on capital gains. So if you're not familiar with what a 1031 exchange is, it's essentially where we exchange one property for another, right? So let's say we buy a property, it goes really well, we're ready to sell it in 3 years. Well, if all the investors agree that instead of taking the profit, we want to reinvest into a newer property, a different property, and rinse and repeat, well, we can do what's called a 1031 exchange, and we can take all the profit from the sale of that first property, roll it over into the new property. No money exchanges our hands. You don't have to receive your income and then send it back to us. This happens all through an intermediary, a third party. And because of this, we get to defer taxes on those capital gains that we would normally incur from the sale of the property. So it's a tremendous, powerful tool that you can only get if you're either an active or passive investor in commercial real estate. You also get the opportunity for wealth accumulation and appreciation, which we've been talking about already. Property values typically increase over time. Obviously, there are market cycles. So it's really important to understand that. Nothing goes up forever. I've been watching the S&P 500 the last several months, and I keep seeing these headlines about record-breaking highs. Every week, it feels like there's a headline about the S&P 500 hitting a record high. Well, I think we're all smart enough on this call to know that nothing goes up forever, and it's the same with real estate. So the good news about real estate is it's not liquid, meaning, if the market drops and you have a bad couple of years, kind of like we have had in 2022 to now, well, you just continue to hold the property, right? You find creative strategies to hold it so that when the market turns around, you can finally sell your property for a profit, right? So that's the beautiful thing about real estate. It's a tangible asset. It's bricks and wood and light fixtures and residents. And that's something that you don't get when investing in the equities market, right? You just continue to hold it until it goes back up. You also get the diversification of income streams, right? You get to protect against market volatility by diversifying outside of traditional income sources, right? So that's kind of what we're talking about now. It's an uncorrelated asset to Wall Street, which is something I love about it the most. So, how does passive income and generating this passive income contribute to your financial freedom, right? Your ability to achieve that second stream of income? Well, first of all, it's income that you're generating without active work, right? So, real estate, if you become a passive investor or just an active investor, if you become a real estate investor, it's going to provide cash flow without requiring daily management, right? So, it's not like exchanging time for money like you probably do at your business or at your W 2 job. It's cash flow that's coming in without necessarily the day to day management. And it allows you to earn income while pursuing other careers or hobbies. Most of the investors I talk to, because my job is to talk to all of our passive investors, they want cash flow, they want equity upside, and they want tax benefits, but they want to do as little work as possible. They're very busy. They've got kids, they've got spouses, they like to travel, they work a busy corporate job. They're very successful in their career. They're making really good money. They don't want to have to learn how to buy a property, how to underwrite a property, how to negotiate on a property, how to get the debt on a property, how to find partners for a property, how to vet a property manager, how to manage the manager, how to deal with the challenges that come along with it. They're hiring us, so to speak, and partnering with us on these projects to not deal with that stuff so they can focus on what matters most to them, which might be their career or their hobbies or their friends or their family, right? So you start to build wealth over time. And that passive income you generate can be reinvested, leading to compounding returns. So I like to use the analogy of a conveyor belt. And I think it's a very powerful analogy. If you picture a conveyor belt, and every year you add one or two real estate investments to that conveyor belt, well, eventually they start to fall off the conveyor belt, and those are the sales of the property, right? So you add one today, this year, 2024, and in 2025, it moves along the conveyor belt and you add two more. And then the next year, the conveyor belt moves along and you add two more. Well, now you have five properties on the conveyor belt. Well, by the end of year five, when the first property falls off the conveyor belt, that $100,000 you invested should now be, as long as the project went well, close to $200,000, if not more, right? So you put 100 in year one, now you have 200. Well, you take that 200, and as much as you might want to stick some dollars in your pocket, if you're investing for the long-term future, now you go reinvest that. You've reinvest that, and you add another property to the conveyor belt. Now you have $200,000 on the last one you added to the conveyor belt, and there's another one about to fall off the conveyor belt because in year two you invested in two properties, $100,000 each. Well, now you have 200,000 fallen off. That's turned into $400,000. Where you take that 400,000 and you add it back to the conveyor belt. Now you just added 600,000 from the first sale and the second sale. Plus, you have two other assets that are still on there from when you first started investing. So it becomes this powerful tool. Well, as long as you keep reinvesting, as long as you have a long-term outlook, you can begin to build just tremendous amounts of wealth. Now, of course, if you're taking some of the cash flow or you're deciding you don't want to reinvest, that's okay too. Some people like to enjoy themselves and take some of that money and go on a vacation or buy a car, and that's totally fine too. But if you're younger and you've got a runway on your career, you've got, I call it at least 10 years before you retire. Starting today, there's no better time, because once you start adding properties to that conveyor belt, then once they fall off, you're going to be very happy. And you get to leverage that analogy, and that's really how you achieve that financial independence you're looking for, just that long-term horizon, right? And investing in multiple properties, the beautiful thing about it is it allows you to create multiple streams of income, right? So maybe some of the properties, when you sell, you reinvest all the profits. Maybe some of it you spend, right? You're diversifying your sources of income beyond just one property, and of course, beyond your primary profession, which reduces your reliance on that one income stream. Some people like to argue that being an entrepreneur, investing in multiple income streams is risky. Well, I would argue that having one income stream, your job, is probably most risky because if you lose your job, you have no income streams, right? So if you're investing in dividend paying stocks, if you're investing in commercial real estate like multifamily, if you're investing in businesses that generate cash flow, these are great ways to mitigate risk so that if you do have that awesome, that great, stable corporate job that pays you really well, if you for some reason get laid off in a recession or like, bankruptcy or whatever happens, you have multiple sources of income coming in. You're not relying on one particular source, right? And that's how you achieve financial flexibility. So passive income offers you the freedom to choose how you spend your time and of course potentially retire early or reduce hours at your work to enjoy life. And that's the beautiful thing. If you're in your mid late 40s or early 50s, if you do this for the next 5 to 7 years, there's a chance you could reach that retirement objective early. Because you probably have a sizable 401k. You probably have, maybe you have a Roth IRA. Maybe you have a nice equities portfolio that you've been investing in through different types of ETFs or different types of index funds or mutual funds, and now you're diversifying your portfolio. You're saying, hey, I want 20 or 30% of my retirement plan to include passive investing in commercial real estate. Well, if you start investing today and you start adding to the conveyor belt, this can help accelerate your journey. So maybe you can retire a few years early. Maybe you don't have to work till you're 65 or 70. You can retire when you're 60, or you can retire when you're 55 if you're in your late 40s or early 50s. You just have to start today. So let's discuss the key steps to getting started with your first investment, right? How do you put this all together? You understand what passive income is, you understand what passive investing is, you understand the power and the benefits that come along with passive real estate investing. What steps do you need to take to get started? What steps do you need to take to start generating that passive income? Well, step number one is arguably the most important is you need to understand what your goals are. There's so many different strategies to invest in real estate, and everybody has different goals, and that's okay. I don't expect your goals to match my goals. I'm at a different place in life compared to you, and vice versa, right? So, are you looking for cash flow? Are you looking for appreciation? Or are you looking for tax benefits? Or are you looking for all three? That's okay too, right? But most investors I talk to, they usually like a mix, but they often lean one way or another. Maybe they're approaching retirement and they're going to need to live on their income from their investments. So they need cash flow. Maybe they have a long runway. They're 45 or 50 and they've got another 20 to 25 years of working. They don't need cash flow. They're making good money at their job. An extra check in the mail is nice, but they don't need it. So they're investing for appreciation and they're investing for long-term equity building. They're looking to build that long-term wealth. Well, understand where you are and then seek what you're looking for before you even get started, because that's going to help you filter out investment opportunities that you might like them. They might look like great deals. They might look like beautiful properties. They might have awesome returns, but they don't match your investing goals. They don't match your investing strategy. So it's okay to say no to them, right? So make sure you set those short-term and long-term goals that you're looking for. That's step number one. Step number two is you have to understand your risk tolerance. And I think this is something that arguably is not talked about enough, but there's risks in investing in real estate, right? So real estate is typically a pretty stable asset class, but it doesn't come without its risks. The last 2 years, we've seen some of those risks, rear their ugly head, right? The Fed started raising interest rates in March of 2022. A lot of investments had floating rate debt, which means that the interest rate was changing from a month to month basis based on where the 10-year treasuries were. So as the market changed and rates went up, we started to see our mortgage payments go up. So that means cash flow dropped and properties that were cash flowing stopped cash flowing. There's a risk involved there, right? So you have to understand your level of risk and understand that nothing is guaranteed, of course. Just because you invest doesn't guarantee, I always say past performance is not indicative of future returns or future performance either, but understand your risk tolerance, right? And risk tolerance is important. I could do a whole webinar on it because different projects, different deals, different asset classes, and different classes within those asset classes have different risk level. For example, if you invest in a C class multifamily property, some people would say that has more risk. Well, why? It has more risk because there's more execution risk. There's renovations, there's construction, there's electrical, there's wiring, there's water, there's getting rid of bad tenants. That's way easier said than done. And it's much harder than it sounds to do. So there's execution risk, and the returns that you're going to see in a B or C class property because of those risks are going to be higher. You're exchanging risk for better returns. Well, what happens if you invest in a brand new or fairly new construction A class property? It's the opposite, right? There's no construction risk. There's very little execution risk because there's no renovations. The only risk is that you're not able to lease the property fast enough, and which of course is a risk, but it's minimal. It's compared to construction risks that come along with tearing down walls and renovating units, right? So because that's less risky, arguably, the returns are lower, right? So it's not bad or good or better or worse. It's which one better aligns with your risk tolerance. So definitely something really important to understand. Step 3 is please make sure you continue to educate yourself. There's quite a number of people here tonight on the webinar, so it always gets me really excited when we have big crowds because it shows me that people are actually trying to educate themselves. You don't have to be here tonight. It's 5 o'clock Central here in Houston. It's 7 o'clock some places, 3 o'clock other places. You might be in a different country. You don't have to be here, but the fact that you are here says volumes about what you're trying to accomplish. You're trying to educate yourself. And maybe you know some of these things, but you're still here, you're still listening, you're reinforcing what you already know. And that's a powerful step in achieving that financial independence, right? So learn about the different types of real estate investments, learn about multifamily, learn about single family, learn about the difference between the two, learn about how these alternative investments compare to, say, investing in a REIT, which is totally different than investing in a private alternative investment like what we do, and familiarize yourself with the language of real estate investing. We use all these fancy terms that if you're in any type of real estate club or you're not in a real estate club, you're going to be like, what are you guys talking about? What is cash on cash? What is IRR? What is average annualized return? What is equity multiple? And what is the gross potential rent? What is net rental income? What are concessions? What's bad debt? Yeah, I mean, there's so many terms that you hear in the multifamily space. You're going to feel like you're lost if you're not educating yourself on the terms and how they can impact your investment. So continue to attend these webinars, listen to podcasts, come to our multifamily property tours that we have with some of our partnership mentorship groups, and that we have also for our investors once a month. We host multifamily property tours here at Headway, and we invite investors to come out and to check out the properties and come and ask questions, whether they're easy questions to answer or hard questions to answer. There's no such thing as a stupid question. So really important you attend those things. Step number 4, choose the right investment vehicle, right? Different investment vehicles are going to have different risks and different returns. Self-storage is very different than multifamily. Mobile home parks are very different than multifamily. Hotels, very different than self-storage. You need to figure out which asset class best align with your investment goals and your risk tolerance, and make sure you choose that one, right? It has to align with your goals and it has to align with your risk tolerance. And I can't emphasize that enough. So what are some tips when you're finally making your decision and you're investing in these properties? What are some tips on choosing the right properties, right? So you understand what passive income is, you're getting educated, you're following all these tips, determining your goals, understanding your risks, you get educated, you feel like you're ready to choose, you picked your investment vehicle, you want to invest in multifamily in this example. How do you choose the right properties or the right assets to invest in? Well, one, you should really focus on location. And this is so crucial. I mean, we're all somewhat real estate savvy here on this webinar. We've all heard the saying, location, location, location. And that's because I can throw as much lipstick as I want on a pig, or I can tear down a building and rebuild it and make it look A++ and super beautiful. But if I am in a bad neighborhood, it doesn't matter, right? The area that you're in is so crucial. So really learn to analyze a location, especially if you're investing outside the city, right? If you're let's say you live in Columbus, Ohio, and you're trying to invest in Kansas City, you need to understand that market. Or if you're in Dallas trying to invest in Houston, or if you're in Houston trying to invest in Dallas, you really need to make sure you understand that market. You don't have to be an expert, but know enough to know the areas which are good, which are bad. And you could do a lot of market research just by using Google. Google's your best friend. Type in an address, type in a zip code, Find out what the average income is in that zip code. What type of jobs are in that area? What type of growth is going on in that area? Is it gentrifying? Is it a nice area? Do they have good schools? All those things are important when you're looking at a property to invest in. Of course, you should also be looking at the market demand and growth trends, right? Are people moving there or are people leaving there? You want to live somewhere where you want to invest somewhere where people are moving, not leaving. Really important. The property's financials, right? Understanding the key metrics. So anytime an investment opportunity goes out, you're going to see some terms that, again, might be a little foreign if you're not getting educated. The first one you might see is cash on cash. What does that even mean? Really important to understand that term. What's a cap rate? We had a whole webinar. Go to our YouTube channel, check out our webinars. We record these and post them online on cap rates. What is a cap rate? If you don't know what it is, it's important you do before you make an investment to make sure that you understand what is the going in cap, what is the exit cap, is there a delta between the entry cap and the exit cap to mitigate risk? I don't know if I'm speaking a foreign language. I definitely recommend you check out our cap rate video on YouTube. Just type in Headway Capital on YouTube and you'll find it on there from a few weeks back. Do you understand what net operating income is, or the expenses that come along with multifamily? Knowing all those things helps you make better investment decisions, because understanding how a property is being underwritten and financially modeled based on their expenses will help you make better investment decisions. Let me give you an example. The average multifamily property and every property is different. Small properties are much different than bigger properties. Location also plays a factor, but on average, you can expect to see a 50% expense ratio when it comes to multifamily. So basically what that means is for every dollar we take in, 50 cents of that dollar goes to expenses. Well, if I send you a property to look at, to invest in, and you see my expenses are at 30 cents on the dollar instead of 50 cents on the dollar, well, that means I'm being super aggressive. I'm assuming that I can cut expenses so much that I get it down to 30 cents on a dollar, 30%. That's extremely unlikely unless I'm a wizard, right? So those are red flags. I wouldn't invest in a deal where I saw a 30% expense ratio. Second, you need to be able to evaluate the property's current performance and future potential, right? So it could be the other way around, though, right? If you now know that the average ratio is about 50% and we're buying a property that's currently at 65%, well, maybe that's the opportunity. The opportunity is to put the expenses back to where they should be. They're overpaying on landscaping. They're overpaying on labor. They're overpaying on materials. They're paying too much to their internet provider. They're paying too much for electricity. There's so many things that can inflate the expenses if you take your eye off the prize. And that could be the value add play, is we need to get expenses in check, right? So if you see that, that could be a good thing, but you also need to ask questions, right? So if you don't understand how to look at those things, you can get lost and end up making a poor investment decision. So really important. The next tip I like to say is look for value add opportunities. And value add just means that you can go in, make renovations, and improve the overall property value. So properties that can be improved or repositioned often offer higher returns. We've already talked about that, right? So if you're investing in a C class property or a B class property, it's going to have higher returns because there's a little bit of risk involved and you're doing some construction and doing some renovation. But that's where you get higher returns. There's also renovation, rebranding, or management changes that can boost income, right? So you want to find properties that have those value add opportunities if you're looking for something that has a little bit more upside. Or you can invest in an A-class property as well that maybe doesn't have all these value add opportunities, but maybe it just needs to be leased up. And that's part of the execution play, is to lease it up, get the rents to market rent where they're supposed to be. And that itself is the play. It's not value add necessarily, it's just stabilization. And then consider the market cycle, right? This is crucial right now, especially because where we're at in the market cycle. So the real estate market fluctuates, and timing your investment can impact returns. Now, let me summarize that because I want to make sure there's not a misinterpretation here. It's impossible to time the market, right? There's an old saying, it's not timing the market, it's time in the market. And there's some truth to that, right? But you can't time the market because here's what you don't want. You don't want to make excuses. And I see this all the time. I've been in real estate since 2017. And I know people I met back in 2017, and I see them sometimes at real estate events. And I say, hey, man, what's going on? What's new in your world? Buy any deals? What are you working on? They're like, oh, no, I haven't found anything yet. They show up to these conferences. They sign up for these masterminds. They sign up for these educational programs. They go to all the events. and they never invest. And you ask them why, and they always have a reason why. Well, prices are too high right now. I'm waiting for prices to drop. Okay, cool. Well, guess what? Prices just dropped 20 to 30% the last couple of years. Oh, well, interest rates are really high right now. I'm waiting for interest rates to drop. Okay, well, interest rates just got cut and we're expecting another 50 to 100 basis points before the end of the year. Oh, well, it's an election year. I'm waiting for the election to be over. Okay, so those types of people, they make excuses for why they should not. They're always looking for a reason not to invest, not a reason to invest, right? So now knowing that, don't try to time the market, but just make sure you understand the investing thesis or the strategy behind that particular investment and when you're getting in. Because it's impossible to know when you're at the top and it's impossible to know if you're at the bottom. You just have to make sure you're sticking to the fundamentals and that you're investing in good properties that are being bought at a good price, that are being bought at a good basis and have good fundamentals. And then stay informed about market conditions to buy at the right time. This is really crucial. And we try to help our investors understand what's going on in the market. Every week on Monday, usually Monday around midday, we send out a newsletter. We call it the Headway Report. And it's a report that summarizes a bunch of articles and information and data that we collect on a weekly basis from all over the internet, all over from various sources that help us draw an opinion of what's going on in the market. And our goal with that is to help you stay informed about market conditions. So if you're not getting that newsletter, you should be. If you're not getting that newsletter, look for it on Monday. It usually comes out Monday afternoon around lunchtime, and make sure you're reading it. It's not a long read. It usually takes 2 or 3 minutes, and there's several links in there to third-party sites. It's not Brian's opinion or it's not Sid's opinion. These are linked to credible sources: JP Morgan Chase, MarketWatch, CNBC, Yahoo Finance, Marcus and Millichap, Newmark, Colliers. These are all credible. RealPage, Zillow. I mean, these are all really credible places that have data scientists and data analysts, and they're putting out opinions. Now, these are opinions, so keep that in mind, but it helps you draw sort of a picture on what's going on in the market if you read enough, look at enough data, and you read enough opinions, so you can make your own opinion about, is now a good time or is now not a good time? Are we going into a recession or are we not going into a recession? Are interest rates going up or interest rates going down? Are rents going to go up or are rents going to go down? If you're reading this stuff and staying up to date in what's going on in the market, you're going to have a better investing track record because you're making good decisions at the right time. So last but not least, let's talk about choosing the right partners, right? We talk about properties. That's really important, but here's the reality. You're betting on the jockey, not the horse. I said that earlier at the beginning of the webinar, and it's so important because if I'm a bad operator and I find a good deal, it doesn't matter because I am a bad operator. Now, I wouldn't necessarily say it's the other way around. If you have a great operator that buys a bad deal, I mean, I'm not going to say they're guaranteed success, but a good or great operator can turn around a bad deal and make turn lemons into lemonade. It's totally possible. But you want to try to avoid investing with a bad operator that has a good deal, right? So you got to choose the right partners. So what are you looking for when you're choosing the right operating partner? People like us here at Headway. Well, one, you're looking for a proven track record. You want to choose sponsors or operators with a history of successful investments. They've done this before. They've been doing this. And even though maybe they've had some trials and tribulations and they have some battle scars, well, personally, I prefer to invest with somebody that has been through the battle. They have the battle scars. They've made some mistakes, and they're not necessarily learning on my dime, right? Because investing with somebody new, that's not necessarily a bad thing. I have invested with new sponsors. I was a new sponsor at some point. It doesn't guarantee failure, but they don't necessarily have the battle scars and the track record, and they don't necessarily know how to navigate tricky times. And while it isn't always pretty, things don't always go according to plan. Operators that have been around a while are usually able to navigate things and come out ahead when it's all said and done, right? So you want to see somebody with a proven track record that's had successful investments, they've sold properties for a profit, and they've been through troubling times. If you've never been through a recession or through a troubled time, kind of like we are now, it's a little tricky to show your battle scars and to know how to navigate the waters, right? You can look at their past deals, communication style, and overall reputation. That's something I like to ask any sponsor I talk to. Tell me about your communication. How often do you send out updates? What do those updates look like? Can you send me a sample of those updates? How am I going to get phone calls or text messages with updates, emails? Do you guys do webinars with updates? Just asking questions like that will help you understand how they communicate and their overall reputation. And then really, you want to evaluate their transparency and communication, right? So how transparent are they being? Are they honest if they're having properties that are struggling? To me, that's a sign of a good sponsor, right? It's okay. If you invest in 1,000 different apartment complexes, you're not going to have 1,000 success stories. There's going to be some properties that underperform or don't do exactly what you hope they would do. It doesn't mean you lost money, but it doesn't mean it's a slam dunk either, right? It just didn't go according to plan. Maybe you were expecting a 2x return and you only get a 1.5%, 1.5x return. Well, it's still a win. You still made money. We just didn't hit the pro forma necessarily, right? So, and a sponsor that can own that and can tell you why and what they learned from it, having that transparency is so important and so crucial. If you talk to somebody and they say they've been around for 10 years and every deal they've done has been a slam dunk and they do nothing but make money and exceed the expectations on every deal, I would kind of raise an eyebrow to that. And I would have some questions about nobody's perfect. It's impossible, right? It's impossible to be perfect. So just trying to see if they take responsibility and they're transparent in their communication. And then last but not least, understanding how they manage investor relations. How many people are on their team? Who are you primarily going to be talking to? Is it a one-man show, right? Is there only one sponsor? And if there are, how is that sponsor going to juggle talking to 10, 20, 30, 40, 50, 100 people, depending on how many partners are in the deal? Understand how they manage their investor relations. Are they using an investor portal? Is it, just done directly through them? All those things are really important for choosing the right partner. Next, you want to make sure you understand the sponsor strategies. Does it align with your goals, which we've talked about a lot? Are they doing value add deals, which are those C and B class properties? Are they doing core properties, which are more A class properties that are in the city? Or are they doing more opportunistic? Opportunistic is something that I would like to call like a D class property. It's a really heavy turnaround, a heavy lift. Maybe it's completely vacant. Maybe it's foreclosed. Those are opportunistic. And ensure their risk tolerance matches yours, right? If you are very risk averse, you don't like risky deals, and you're talking to a sponsor who does nothing but risky deals, you should probably go somewhere else, right? And vice versa. If you're looking for deals that have a little bit more upside, you like risk, and you're talking to a sponsor who only invests in brand new construction A class, well, that might not match your investing thesis. They're not taking on risks of the renovations, right? In the B and C class space. They're not going to be able to force rents as much. So maybe you should find somewhere else, right? And then you want to check for an alignment of interest. This is really important to make sure that they have skin in the game. That just means that they're putting their money where their mouth is. So we are always making sure we have skin in the game in all of our deals. Most of our investments, we're the largest investor in the deal, right? So if our minimum investment is 50K, we're going to have significantly more than 50K in the deal, usually north of 250. And part of that is because the lender actually requires you to have a certain amount in the deal. They're not going to let us just put 50K in the deal. But you want to make sure that the operator has skin in the game, right? You want them to be investing alongside you, and that will help make sure that their interests are aligned, right? So it's really, really, really important. So what are some challenges you could have in passive investing, right? We talked a little bit about this already. Understanding the learning curve. Real estate has a steep learning curve, but education and good partners mitigate that, right? So if all this is kind of foreign to you and you feel like, man, this is going to be kind of a challenge for me to figure out, that's okay. It's okay. We all started from zero. I started from nothing. I didn't come from a real estate family or background. I have a business background, but I wasn't in real estate. And I learned, right? It took me several years. I'm 7 years in now, which is crazy, but it takes time. And you can mitigate that just by being in rooms full of really smart people. I like being the dumbest guy in the room because that just means I'm learning from everybody. So try to find yourself in rooms like that and try to attend these types of webinars, read the content, watch the videos on YouTube, attend in-person events if you can, and ultimately find good partners. Secondly, it's really important you manage your expectations. Real estate is a long-term investment. Patience is key. If you're trying to become a passive investor because you want to get rich overnight, you can just go ahead and drop from that webinar right now because you're just in the wrong place. Real estate is a long-term investment. Our investment cycles are 3 to 5 years, sometimes longer if the market goes in the wrong direction or if we all agree we want to refinance and hold longer. But typically we're looking for 3 to 5 year targets. So you got to have patience, right? You got to be prepared for fluctuations in cash flow. And you got to be prepared for market conditions to change. We've seen that. We've talked about that a little already today, where the market turned a little bit, well, a lot in 2022. It happened in 2008, 2009, 2010, 2011 during the great financial crisis. I'm sure some people here remember that. So these things are out of our control. We don't wake up and do anything to cause the market to do that, but it happens, right? Recessions happen, markets change, banks do crazy stuff, the Fed does crazy stuff, politicians do crazy stuff, and it impacts us. And all we can do is ride the wave and understand how to navigate those waters. So just being prepared for that is important and not being surprised. But you just want to make sure you're working with sponsors that are tried and true and that are transparent. Performing due diligence is also a way to overcome challenges. So if you're just looking at a deal and going, man, this looks awesome, here's my money. Well, that's not enough due diligence. That's going to help you. Doing due diligence is going to help you avoid bad deals. So research the sponsor, look at the property, make sure you're going to it if it's in your area. Ask if you can visit the property from the sponsor. And don't rush into investments without understanding the risks. That's really, really important. Don't get FOMO, which stands for fear of missing out. If you get FOMO and you invest just because your friend's investing, well, that's a recipe for disaster. You want to make sure you understand what you're investing in and understand the risks that are involved and also understand the upside that's involved. And then make sure you're diversifying your portfolio and avoid putting all your capital in one deal, right? So it's not uncommon that we get phone calls from investors that have had a successful exit, or they've just have quite a bit of money and they're like, hey, Brian, I got, 500K, I want to put it in your next deal. Well, I'm like, whoa, slow down there. While I would love to partner with you, we don't want to take that much of somebody's capital, and I just met you, right? We want you to diversify. So I would rather you hold on to that 500K, maybe put 100 or 150K in my deal, and then look for other opportunities, whether they're from us or other operators, because you want to diversify your portfolio with different operators. You want to diversify your portfolio with different deals. Avoid putting all your capital into one deal, right? So different markets, different asset classes, different operators is the best way to mitigate risks. So final statement, today we talked about creating that second stream of passive income, what passive income is, how to get started, how to set your goals and expectations, how to find properties, and how to vet the sponsor. So hopefully this was super helpful for you because not everyone knows how to do this, right? It's really hard when you're first getting started, learning how to create that second stream of income. If you just go on YouTube and you watch a video, they're like, hey, all you got to do is find a deal and invest and the money starts coming in. Well, there's a lot of steps along the way that you really have to follow. And if you skip steps, it doesn't guarantee failure, but it sure as heck doesn't help your opportunity or your chances of success, right? So we here at Headway Capital, our job is to try to help educate you so you understand what you're getting into and to try to provide as much education as we can so that you can make good risk-adjusted decisions. If you're not a part of our private investor club and you want to participate in those risk-adjusted investment opportunities, I encourage you to reach out to me. Anybody who schedules a call with me is going to get the opportunity to join our private investor club. We just have to have a quick call to make sure you're accredited or sophisticated. And accredited just means you have a $1 million net worth. And if you don't, that's okay too. We do work with sophisticated investors, but I have to have a quick phone call with you just to make sure you understand what you're getting into, the pros, the cons, the risks involved, the upsides involved, and make sure you have a clear understanding of what we do here at Headway. And before we give you access to our opportunities. So if you want to apply for our private investor club, scan this QR code or just shoot me a quick email, brian@headwaycapital.us, or reply to the email that you'll get on Monday with the newsletter or any of the emails you get from us. And I'm happy to schedule a call with you just to get you on our investor list so you can actually see the deals that we offer. We don't have any open multifamily deals at the moment, but we are looking for our next opportunity. So we want to make sure you don't miss out. Our last deal was fully subscribed and we filled it up in a few weeks. And that was about 8 weeks ago, or actually that was back in July. Sorry. We closed about 8 weeks ago. But so we want to make sure that you don't miss out on those opportunities. So we got to make sure you schedule a call because we can't take the investment of anyone we haven't talked to. Right now, we do have an open investment opportunity. If you're looking for cash flow, then this is for you. This is our real estate income fund where we essentially raise capital from investors and we give loans out to single family fix and flip investors. This has been a very successful offering for us. Last month alone, we loaned out over $11 million on over 40 projects. Which is just crazy to think about. Just back in March, it was right over 9 million that we were lending it per month. Now we're at 11 million. This product has seen tremendous demand on the customer facing side. So we have a sister company that we've partnered with that offers hard money loans to investors. They're short-term loans. They're about 6 months long. We charge them about a 13% interest rate, and we're able to pay our investors an 8% return for a $100,000 investment because of that higher interest rate, the arbitrage there. So it's been around since 2020. We've given out over $270 million worth of loans since then, which equates to over 1,400 loans. And we've never lost money on any deals, which is phenomenal. And your investment is mitigated across the entire risk mitigated because it's spread out across the entire portfolio. You're not investing 100K into one house. You're investing it into all the transactions that are in the portfolio at the time, which is usually somewhere around 40 projects. So it's not impossible, but very unlikely that 40 projects all go south at the same time. Here are the returns you can expect if you decide you want to invest in this project. It is for accredited investors only, and if you invest at least 25,000, it provides a 6% return up to 99,000. Anything over 100,000 pays an 8% return. If you invest over $500,000, it provides 9%, and $1 million or more provides a 10%. There is no lockup period for the first two options. If you invest 500,000 or more, there is a 6-month lockup period, but anything under that has no lockup period. There is a 90-day liquidity option. So that means if you invest anything under $500,000, all you got to do is send me an email and say, hey, Brian, I want my money back, and I will get it to you in 90 days or less. And investors are paid monthly on this, so it's a great way to earn cash flow. You can scan this QR code if you want to learn more about our Headway Income Fund, or just reach out to me. I'm happy to schedule a call with you or send you the pitch deck, the offering memorandum, and I'll give you access to our investor portal in case you want to subscribe. So let's jump into Q&A here and see if we can answer some questions. So if you have a question, please put it in the Q&A box. There are quite a few people here, so I'm going to try to get to as many of them as I can. If I don't get to your question, then just shoot me an email. I'll do my best to try to reply to you. I always try to reply as fast as I can. Just shoot me an email and I will get you an answer as quick as I can. So first question I see here. What's the difference between a private investment and a REIT? Good question. I think in one of the slides I mentioned a REIT. So a REIT is like investing in a stock. That's the easiest way I can kind of describe it. With us, you're investing in a particular project. It's a particular asset. You'll know exactly what the address is. You'll get to drive by and touch it. We do tours on it. You can come walk it, see what's going on. You get to talk to me or Sid or any of our Umar, Hader, all the people on our team that are in operations. If you invest in a REIT, it's like investing in a stock, right? You're investing in a portfolio of real estate projects. You don't get to have any say or any influence in the projects. You can't call the operator and say, hey, I have a question about this. You're just an investor, just like you are in a stock, right? So great question. Let's see what else. What type of returns can I expect from multifamily projects? I see your fund offers a 6 to 8% return. Does multifamily pay similar? Good question. I'll give you an answer based on what we're seeing currently in the market. We are currently looking for projects that push out around a 7% average cash on cash return. And I say average because that means that year one might be a little lower because we're renovating the property and getting rid of the bad tenants. So you might see 4 or 5% year one, but it ramps up from there, right? And our average annual return that we're forecasting is at least 20%, but we try to aim for 25 or more. So what that means is over the course of a 5-year period, when you add up all the cash flow you've gotten, so let's just call that 7% to 8%, and then you get your proceeds on the exit, the profit sharing on the exit, which typically our deals are either 70-30 or 80-20, which means 70 cents out of every dollar of profit, 70 cents goes to our passive investors, 30 cents goes to us. When you add all those profits up, you're going to have about a 20 to 25% average annualized return. So the fund that I just showed you doesn't have any upside. This is just straight cash flow. It's just a cash flow play. So there's no upside. You don't get the profit share on the deals once they sell. Once they flip these houses, we don't get anything. We're simply giving them a loan that costs 13% to them, and we're giving out there's an arbitrage play. We give out 8% or more to our investors, and we of course make a little bit of money here at Headway as well to cover some of our overhead and expenses and stick a few dollars in our pocket as well. So that's how we pay this out. There's no upside. There's no tax benefits that come along with this, just like there would be with multifamily. So a good question. Let's see. How can this impact my retirement? I think we kind of talked about that. Retirement, I think leveraging this as part of your retirement plan is really powerful. I would always encourage anyone who's looking to plan for retirement to speak to a financial manager or wealth manager. And not all wealth managers are going to be bullish on these types of investments. Some might tell you they're risky or they wouldn't do that. Well, remember that they are compensated often based on AUM. We don't get paid based on AUM, right? So you can invest $10 million with me. I don't get a fee for you investing $10 million with me. We don't charge AUM fees like a wealth manager would, right? We collect fees at the beginning when we buy the deal. We make a little bit of money. Of course, most of that goes to covering employees' overhead and company offices and things like that. And then we really make our money on performance. We make our money when the deal sells and it's successful. So that's how we're incentivized. So not all wealth managers and financial advisors are going to say like, "Hey, you should do this," because they want you to keep all your money in the equities market so that they can make an AUM fee. But the good ones, and I know several good ones, they love this. They love passive investing. They love private investment, and they call these alternatives. They love when their clients diversify their portfolio and to have some alternatives, right? Now, you shouldn't be 100% in alternatives, or unless you love real estate or crypto and other things like that. But you should have some of your portfolio in alternatives. That percentage is up to you. A common number I see is 20 to 30%, right? So if you're talking to a wealth manager, talk to them about how you can leverage alternative investment and how you can shave off a part of your portfolio to start investing passively in real estate, whether you have cash or if you use a self-directed IRA. We do accept funds from investments using a self-directed IRA. So if you have an IRA account and you want to invest in the income fund here, or you want to invest in one of our multifamily projects, you can do so. Talk to your financial advisor about that. And I can also help you get connected to an IRA custodian so you can begin to take advantage of that. So just reach out and ask me. I'm happy to make introductions. Let's see what else we got here. I think we already answered that. How often do investors receive distributions? We talked about that. Quarterlies typically. Here, how many streams of income do I need? That's a good question. I don't think there's really a limit. I would encourage investors to analyze themselves and what they're really looking for when they decide how many deals they want to invest in. I had a great call earlier today with somebody who said they plan on investing in 2 deals per year, and they have about 10 years until they retire. And I think that's a phenomenal strategy. He had a clear plan. He knew exactly how many deals he was investing in. He's already starting to carve the money aside. He wants to put 100K in 2 deals. So he's going to put that money aside every year, and that's his plan. Is he goes throughout the year and he finds the 2 best deals he can. And once he's invested in those 2 deals, maybe he'll invest in both of them in January and not have to worry about it for 11 months. Or maybe he'll invest in one in the first half of the year and one in the second half of the year. There's no really right or wrong. Invest in the deals you believe in the most, but he's got a plan, right? And I think that's step one, is having a plan, knowing what the next 5 to 10 years look like for you, knowing how many deals you want to invest in, being disciplined, right? Not just saying, "Oh man, I want to put all my money in real estate. I'm going to invest in 10 deals next year." Well, that sounds great, but what if you don't find 10 great deals? You might be investing in some bad deals, right? So be realistic with yourself. The last question here, how much capital do I need to start passive investing in real estate? That's a great question. I will say it's really important that you are not investing all your dollars in one deal. That's a question we always ask our investors when we get on a call with them, which is why it's so important, is what's their job, how much money do they make, and how liquid are they? What type of assets do they have? And it's not because I want to be all up in your business. It's because I need to know that I'm not taking your last dollar. If you invest $50,000 in one of our projects, I want to make sure you've got money in the bank afterwards in case something bad were to happen, right? A car accident, or you need to repair your home, or let's say the deal goes bad for some reason and all the money is lost, which we've never done that before, but it's not impossible, right? So there are risks with every investment. So we want to make sure we're not taking your last dollar. So I would say you need to have a significant amount of net worth to do this. I don't have an exact number, but you don't want to be investing your last $50,000, right? So that's why we try to work with a lot of accredited investors, which means they have at least $1 million net worth. That doesn't mean they have $1 million in cash, but they have $1 million net worth, which means they've got some assets somewhere else. Maybe it's real estate, maybe it's equities, maybe it's their 401k, maybe it's their IRA. So for some reason they invest $50,000 and it doesn't go well, their life's not over. It's not ideal, of course, but they can recover from that, right? So I would say you want to make sure you have some money set aside. Me personally, I probably wouldn't start investing passively unless I had a few $100,000, knowing that these investments are $50,000 at a time. If you only have 50 or 75,000, you're just taking an inordinate amount of risk, in my opinion, investing 75 or 80% of your cash into one project, kind of banking that on it's going to work. So I think that's a little risky in my opinion. So no right or wrong. I'm happy to take that conversation offline with anybody who wants to schedule a call. So that's all I got for you guys tonight. We've been here for about an hour, so I appreciate everyone's time. I want to say thank you. Please reach out to us. You can reach out to me directly at brian@headwaycapital.us. Or you can reach out to our team at investor@headwaycapital.us. I appreciate everyone attending today's webinar. I look forward to seeing you at the next one, and I hope everyone has a good evening.